You said you have 11 policies. How many people is that?
I have 8 different bodies insured. Now I have 4 on my wife, my 3 stepsons. I finally got my policy on myself. Long-term care could be the greatest expense we face in our later years. Not let care for me or my wife wipe out what I've worked so hard to achieve.
This is a 3-year deferred. So income will not start until 3 years down the road. And look at the difference right there. $3,632 of income guaranteed for the life for this couple. If they wait 5 years to get income from this thing, look at the income. It's $4,116 if they do it for 5 years.
If you were to have 30% of all your assets sitting in permanent life insurance and 30% of your assets sitting in income annuities and the rest of your money sitting in investments, whatever that investing is, the stock market, real estate, any risk you want to take, that would provide you the highest retirement income with the relatively highest death benefit as well. I knew whole life was powerful. I knew annuities can be powerful to guarantee income, but I didn't realize how powerful it actually was.
There are these variable and index annuities, and why do people put their clients in them? Because these variable and index annuities can have incredibly high commissions because they're complicated. Make sure you get someone who's going to put you in a good annuity for you, the right one, not the one that's going to pay them the highest commission.
A lot of people don't think about retirement until it's too late down the road. And so we got Carson on here. Carson's in his early 20s or mid 20s, going to be talking about how he got into infinite banking, going to be talking about how he's using infinite banking to create more wealth in his life for retirement down the road. I got Mike Samet here, who is Mike, I think you're around 60 years old. And so how has he been using infinite banking to create more assets, more cash flow, that kind of stuff? But additionally, what we're all going to do is also go through case studies of our own clients. How have we helped them have a better retirement? How have we helped them have a better strategy around the future? What are a lot of those strategies doing for people? What are they causing them to have? When it comes to your money, when it comes to building wealth, and especially your financial future, you want certainty around that. And unfortunately, if only 5 out of 100 people on average are having financial certainty in retirement, that's scary. We want to be one of those 5. So we're going to talk about that. And then we also have some other members from our wealth team. They're going to come on and talk through some of the different things when it comes to index products, that kind of stuff. You guys introduce yourselves real quick, and then we'll dive into it. So, Carson, you want to just do a quick introduction?
Let's do it. Yeah, excited to be here, guys. I'm Carson Herleen. I'm in Southern California. I'm not in my office today, actually traveling, and so pumped to be with you guys. We love doing these webinars every week because, especially for me, as Brian said, I'm in my 20s. Learning about this, anything in the money space, in the retirement space, the banking space, there's so much to learn. Every single month, I feel like I learn something new. I hope you guys listening do too. But there's so much we can keep learning about this space. And the deeper you dive into it, the more you realize there's actually more rabbit holes to go down and more things to be discovering. So thank you for being here today. We're excited to share some really important stuff with you. I'll get it kickstarted here in a minute with some of the stuff I want to get into. But before we do, let's keep running around the round robin here. We got Stefan and Brandon over there in New York. We can go down to you guys.
Hi, I'm Stefan Astheimer. I lead PMC Wealth Advisors. We're the registered investment advisors that works with the whole BYOB community. I'm delighted to be here today. Thank you for the intro, Carson, and Tess. Good to see you again, too. Really excited to be sharing a little bit of our perspective on things and to be joining the great money mentors speaking as well. And looking forward to having a great conversation this afternoon. Mike, I'll pass it over to you.
Thank you. This is Mike Samet in St. Augustine, Florida. I'm just hoping I don't lose power. Pretty bad storms here in North Florida. So I'm an infinite banking and long-term care specialist. Never too late to do this. I was 56 when I heard about the infinite banking concept. So I've been practicing this for 4 years and working beautifully in my life, which I will share with you in a minute.
Awesome.
Mike,
Awesome.
that makes me think, man, we should do a webinar, just you and I, and talk about, hey, you learned this at 56, I learned this at 19,
There you go.
and 10 years down the line, what are our different perspectives of how we should definitely do something like
That
that.
sounds
Maybe we do
great. And we
hit that
love
today.
it. And the youngest money mentor and the oldest money mentor. So yeah,
Yeah,
that would be a good
Yeah.
one, Carson.
Yeah.
I love it.
It's kind of interesting you mentioned that too, because I've had some conversations about certain products that I'm going to talk about here in a moment. Talk to someone who's in their 50s and someone's in their 20s. And they're saying, and someone actually, it was you, Carson, yesterday, I think it was yesterday or Monday, asked, well, does this product make sense for someone in their 20s? And I actually had a conversation with someone in their 20s, and it makes perfect sense. It's different, different conversation, but it makes perfect sense. So I'm pretty excited to talk about that. So everybody, yes, I'm Brian Fouts up here in North Idaho, one of the money mentors and also one of the annuity specialists on our team, along with Tess, who does annuities as well. So I'm going to be talking about that here today. I'll share a bit about my story, how I got into infinite banking. I think I've been doing infinite banking for 14 years. Not going to say I was doing it the best when I first got into it because whole story there, but I'm going to go through that and also how I've been helping people. I've helped probably about 2 to 3 thousand people do infinite banking over my that time span so far. So going to be fun. But as I said, we're going to each spend some time going through our journey, going through some different topics, and then also how we're helping clients. So we're going to start with Carson here. Carson's been doing this. You've been doing infinite banking since you're 19. Learned about it, correct?
Correct.
And how old are you right now?
24.
24. So that's awesome, man. I wish I got my start when I was 19, but unfortunately it was in my mid 30s when I first heard about this. So with that, Carson's going to share some about his journey, and then also he's got a case study or a white paper that he's going to be sharing as well that talks about retirement stuff. But I'll let you take it away, Carson.
Yeah. So those of you who are on here today, most people understand the infinite banking concept or have been around our campfire for a couple of years, few months, however long the time is for you. Sounds like there's only a few new people on here. So I will give a real brief recap on infinite banking before we get into it in case those of you on here are new, don't understand that or know what the main strategy is that we're talking about today. Because we're going to go down some different rabbit holes, like Brian's talking about some retirement income planning. And retirement income planning is a whole different game, whole different beast than just using these insurance policies to do banking. And so we got to understand both of these worlds to really understand how they collide. And so for the case of IBC, the whole point of infinite banking is finding a better system to be financing things through. Every single one of us on this call saves money, makes money, puts money somewhere. Like we all do that, right? We all can agree that's very simple, basic stuff. But where are we choosing to put that money? Where are we choosing to save those dollars? And I would assume most of you, like me before, were saving money when we in our savings accounts, checking accounts, really anywhere that was just a liquid place. We teach a strategy using whole life insurance as this new savings vehicle, a new place to store capital rather than storing money in a checking account or a savings account, because everything you put into this policy earns interest. It's guaranteed to grow every single day of your life. It has a dividend built into it, so it has some upside and compound growth. It's tax-free, which you barely get in any other investment vehicles. It has a death benefit too to protect you and your family, and all the funds you put into it are still liquid and available. And so if you can store cash somewhere that's liquid and available but has all those additional benefits as well, why would we not? Right? That's an easy change. So we're just changing that one thing in everyone's life is where we're storing that money. And like we save money for purchases, investments, debts, that's what we all save money for. Why don't we just do those transactions through this new vehicle? Let's save money in this better spot. And then once it's here, let's leverage it. Let's use it to go pay off debts, make investments, just save up capital in general, just like we're using our savings accounts today. Again, this just being a new and better savings vehicle. And so, in a 2-minute brief overview, that's the concept of IBC. We're finding ways to finance our lifestyle through this own private system that's a more efficient vehicle to store money. And so, that being said, most of the time, we're teaching strategies of, like I said, paying off debts or buying real estate or flipping properties through our savings vehicle, this policy. However, there's a lot more that goes into this policy, a lot deeper and more valuable this product can be for you over time than I think a lot of us realize at first glance of this strategy. For me, when I first learned this strategy at 19, um, I just thought it was a good system to be saving money and build a foundation of capital and learn banking and why we'd want to be an honest banker with ourselves and pay ourselves. It was good principles to learn. But the deeper I dove into this, the more I realized, oh, wow, this is one of the most versatile assets I've ever seen. It can be something to use today, no matter how old you are. It can be something you use in 10 years and in retirement and post-retirement. And if you don't ever use it, it's a legacy you pass down to your kids. It can be everything and the foundation of all things you do in your finances. And so it plays a lot of roles. Now, that being said, what I want to show today is a white paper done by a very popular global financial institution talking about that longer term usage of these insurance policies. And so I'm gonna screen share here and get into that. Before I do, anything else you guys want to add, you four, any questions you have for me before I share that?
Yeah, I actually would like to, because I know that you've been in the real estate space. So, like, how are you using your policies right now? Like, what are some of the things you've used yours for?
Good question. So for me, and this is I think I honestly don't think it matters how old you are. Everyone has the same needs. Everyone wants to save money. Everyone wants to pay off debts. Everyone wants to make investments. Doesn't matter your age or how much money you save. And so I'm in that same boat, except I'm building my foundation of capital because I know opportunities will come my way. I know investments will come my way. I know future business opportunities will come my way. I'm gathering all my funds, building up this reservoir of capital for those opportunities. And so right now in my life, that's what I've been using my policy for is literally just capitalizing, funding them every year, maxing out the paid up additions, building up cash value. And frankly, I haven't taken a loan in a year or two. I'm just building these funds up for a future opportunity. And those of you watching, I think sometimes we meet with clients who are like, well, I was told I have to take money out to make this system work. No, you don't. If you
No.
just let money sit there for 5 years, great. You've not built up 5 years of a reservoir to go make any investment you want when the perfect opportunity comes around. And so don't feel like you need to, don't feel like you need to be in a rush. This is a long-term system. I'm using this long term. Everyone on here is using this long term. So for me, I'm just saving capital up for those opportunities. And I think a lot of people need to hear that message as well.
And then now I know you're obviously in your mid-20s. So when you are thinking, and we'll get into this here in a moment on your
Yeah.
thing here, but how do you think about retirement with your policies at your age, or do you even think about retirement? Is that even something you even are putting energy towards?
Yeah, it's a fair question. I think I definitely am putting energy towards it. Um, because I have the right financial principles. I guess I wouldn't say I'm directly thinking I'm making this decision because it's going to help me in retirement. I'm not necessarily making decisions in that way. I'm not thinking about it in that way. Like some might, if they're 50 or 60 going into retirement, they're probably thinking of how will this affect me in 5 years when I retire? No, I'm not thinking about it in that way. But every decision I'm making is building such a strong foundation that will help me at that point, and I'm aware of it at least, that I think um, I'm getting that I am planning long term without intentionally planning long term, if that makes sense.
Well, you're planting the seeds right now, and like, and I'll get into my story a little bit, but you're planting those seeds right now, knowing they're going to bear fruit down the road, and you're just going to be planting
Yeah.
more and more seeds down the road as well.
Yeah.
So versus having to play catch up like some people. So, all
Yeah.
right, well, let's go ahead and
100%.
share what you that white paper there. I'm pretty excited to see it because I actually have not read through it yet.
Let's do it. So, all right. Those of you who obviously are new, try and just bear with us, stick through this whole webinar. I hope by the end you start really grasping the stuff we're talking about. This is going to be some new stuff. But this is a white paper, a very large research study done by Ernst& and Young, if this logo is familiar to you. Again, a global financial institution, very, very big. And they did this report, I think it was 2 years ago, year and a half ago, very, very recent. And they were studying how life insurance and whole life specifically plays a role in retirement planning and just in your investing patterns. A lot of people in the financial space, you go talk to financial advisors all over the country, they're going to tell you whole life sucks. They're going to tell you life insurance is a terrible investment. They're going to tell you life insurance should never be a part of your retirement plan. This report will be directly against that. Everything those principles are talking about from traditional financial advisors, this will be everything opposite of that, proving mathematically why they're all wrong. And so I don't want to get on a tangent here, but if you guys are going home after this webinar, you talk to your family, your friends, your spouse, business partner, and they're like, "Oh, I've heard of that thing. That does not make sense. Don't do that. Whole life is a bad investment." They have no idea what they're talking about because they don't. This is the actual research behind that. And so, benefits of insurance products in your retirement planning. Two insurance products are going to be discussed in this. We'll show you here in a second. So, I will read a few of these sections just so we can kind of get a gist of what this white paper research is all about. The introduction is right here. Although facing challenges, the U.S. life insurance and retirement industry has enormous potential to grow. Ernst& and Young researchers estimate that by 2030, there will be a $240 trillion retirement savings gap and a $160 trillion protection gap. Insurers are uniquely positioned to address these gaps with products that offer legacy protection, tax-deferred savings growth, and guaranteed income for life. They're talking about life insurance. In this paper, we explore how two products can be used to meet investors' savings and protection needs: permanent life insurance and deferred income annuities. Now, I'm going to focus on the insurance piece. The other guys on here today will talk about the annuity piece, so I won't go too deep into this, but we're going to talk about annuities and life insurance, which represents deferred income annuities with persistency bonuses and non-guaranteed dividends. Our analysis focuses on whether integrating life insurance and annuities into a financial plan provides value relative to an investment-only strategy. Investment-only strategy meaning put all your money in the 401k, hope it works. Specifically, we conducted case study analyses to determine the optimal allocation of an investor's assets to the insurance products. They did, well, actually, I'll just keep reading. I'll show you what I'm talking about. So we considered 5 different strategies in this analysis. Investment only, meaning, again, just 401k, just the stock market, just the S&P, whatever investment only strategy they're doing. Then they compared buying term insurance and investing in those products. So just like Dave Ramsey teaches, buy term, invest the difference, they add that comparison in this. Then they say, what if you add life insurance in your investments? Then what if they said, or what if they do annuities in your investments? And then they combine it all, life insurance, annuities, and your investments. So to compare these different strategies, they use Monte Carlo analyses, which generates thousands of scenarios, each of which contains time series of interest rates, inflation rates, equity returns, and bond returns across the planning horizon. Basically, what that means is these people took every single different investment scenario possible, went through thousands of variations, and came back and said, here's the most likely scenarios to happen. And so we want to find out what we can get a 90% success rate of not running out of money, having the income we want in retirement, and building the largest legacy possible. And so that's what they're calculating, is how to build the largest legacy possible and have the most guaranteed income in retirement. And so they show 3 different case studies, and each case study gets older and older. This is a 25-year-old couple who has 80 grand a year in household income. They've already saved up 45 grand. They save a good chunk of their income. They have a 70-year time horizon for their money to build up and last them until they pass away. So what they show is, from investment only strategy, if you're to just put all your funds in this investment piece, whatever the investment is, S&P, and let it grow for that whole period of time and then pull from it for income, with the highest likelihood of not running out of money, you would have about a $61,000 a year retirement income. And that would leave you about a $3 million legacy for your family if you were to pass away. And so this is the baseline all other projections are going to be based off of. So these columns here, percentage change versus investment only, percentage change versus investment only, these are the metrics we're looking at. How do these alternative scenarios of incorporating life insurance, what's the change based off of the income and the legacy from the investment only scenario? And so PLI stands for permanent life insurance. And so to start, they show you, what about permanent life insurance, whole life versus term life? What are the comparisons of income in retirement and legacy to be left behind? This showing this research right here is actually super fascinating and basically breaks down everything Dave Ramsey says. If you had 10% of your entire assets sitting in whole life and the rest in investments, or 10% of your entire, or not investments, but yeah, in term life and investments, whole life will have higher income the rest of your life and a larger legacy, meaning more death benefit. Every single one of these scenarios, if it's 30% in whole life or term, 50%, 50%, it's higher with whole life in every single scenario compared to term. And every single one of these scenarios are higher than if you invested only on your own. And the legacy is larger and larger the more you contribute towards it, which would make sense, right? Mm-hmm. And so right off the bat, this is what they're showing you from the beginning. Term versus whole life. Then if you layered on annuities, deferred income annuities, what DIA stands for, they go through those scenarios, which I won't hit here because we show it one more time. They put everything on this one column. Again, age 25, saving for their whole lifetime. What's the highest probability of not running out of money? That would be this. The largest change in income, meaning the highest growth in income, is actually down here. If you put all your funds in annuities only, you would receive a higher income. However, not a very big legacy at the end of the day compared to the whole life. If you add whole life and annuities, this combination, that would give you the highest legacy and highest change in income relative to the rest of them. To sum this graph up, I know it's kind of a lot of numbers, a lot of charts. I'm trying to be simple with it because there's a lot that goes into this. I could take a whole hour and a half explaining this whole white paper. To sum this up, if you were to have 30% of all your assets sitting in permanent life insurance and 30% of your assets sitting in income annuities and the rest of your money sitting in investments, whatever that investing is, the stock market, real estate, any risk you want to take, that would provide you the highest retirement income with the relatively highest death benefit as well. And so this fact right here blew my mind. I knew whole life was powerful. I knew annuities can be powerful to guarantee income, but I didn't realize how powerful it actually was. 30 and how much of your entire portfolio could make sense to be sitting in these assets. 30% of your whole portfolio sitting in whole life. Try and tell your financial advisor to do that, right? and 30% of your entire portfolio sitting in annuities. Again, try and tell your advisor to do that. That would make no sense. This would hurt a financial advisor's brain. Excited we have Stefan on here to share his perspective here in a little bit. But this is what the math said, and all the research came back to for these scenarios again is that portfolio allocation to give you the most amount of income and the largest legacy to leave behind in retirement. Now, of course, there's alternative scenarios. What if you invest and you can get better returns in the market? What if you can't qualify for life insurance? What if you can't get into, what if you're too, sure, all the different scenarios and one-offs can make these scenarios different. But just for the purpose of understanding the principles of how we're making some of these financial decisions, this is some really cool research.
Yeah. So it's interesting. So if you look at most people's portfolios, now, once again, by the way, but this is not financial advice. We're not giving financial advice here at all. We're not financial planners. Stefan is, though, of course, but we're not doing that here. But we just want to share some of the research that we're looking at. But what's interesting here, 30% to whole life, 30% to income annuities, and 40% to other investment strategies. What I've seen a lot when I'm talking to clients is that a lot of people have sometimes 100% of their portfolio in the investment category, which I'll get into this in a little bit. That's the risk category. But they don't understand that you can actually move money from that bucket to the actual guaranteed bucket, because the investment side is typically not guaranteed. But you can move it from that to another guaranteed bucket and start to diversify out of it. What a lot of financial advisors I've heard, what they'll say is oh, in your early years, have riskier investments, higher returns. In your middle years, kind of diversify into, more conservative, and then in retirement, go very conservative, low risk. But they're still keeping it inside an investment vehicle, that bucket right there, where you can move it out of that and get higher returns, which is exactly what this white paper is showing you right here. So appreciate sharing that. Anything else you want to go through on this one, Carson?
I'll just wrap it up with this. They did the same projections for a 35-year-old couple. Okay. Same thing. And the research is the same.
Oh, geez.
Highest, right? To include legacy and income, the highest is 30% and 30%. They did it again with 45-year-olds, same result. I forget where it was here at the end. They show here a different chart to show the 45-year-olds, but same thing for 35-year-old couples, 45-year-old couples, and they keep going on and on. So doesn't matter where you were starting. This system makes sense because we're taking risk off the table. We're guaranteeing income, guaranteeing some of your assets, and providing an actual income plan and not just hope that the market will do what you're expecting it to do.
Yep. Awesome.
All right. Great job, Carson.
That was awesome.
Very informative.
Yeah.
Thank you.
I did all the things I was supposed to do. Like Carson said, term insurance. It's what I was taught to do. Buy term, invest the rest. Of course, no one invests the rest. They spend the rest. So when my first child was born, got my first term policy. Second child, got my second term policy. And I underspent my income, lived beneath my means, like you're supposed to do, which allowed me to max out my 401k, which I did. And once I turned 50, I did the catch-up contribution. So it grew very nicely. I'm not upset about that. If I didn't do it, I probably would have spent the money. But several things bothered me over the years during this accumulation phase. The majority of the money was in the stock market of some sort, S&P 500, NASDAQ, large caps, small caps, mutual funds, ETFs, market. Because where else are you going to put your money? Because that's all that Fidelity does and so forth. And it goes up and down. Zero control. That bothered me. So kind of buy, hold, and pray kind of mentality. Who's to say the market's going to be up when you want to sell? So I lost hundreds of thousands of dollars during the dot-com bubble. I'm dating myself. And the same thing happened in the financial crisis, 2008, hundreds of thousands of dollars gone because the market's doing this. Ideally, it should go up, but I'm riding that roller coaster for maybe 8% return over 30 years. Horrible risk reward. So I did some real estate investing. Loved the monthly cash flow at rental properties. Didn't like the terrible T's, termites, toilets, and tenants, but I loved the monthly cash flow. So back to the 401k, all that money never taxed. All the money I injected into it, never taxed. The growth of it, never taxed. Tax ticking time bomb. So when I'm 75, the government says you're going to have to start taking withdrawals, RMDs. Could be incredibly expensive at that time. So again, I don't like when someone tells me what I can and cannot do with my money. I love control of my money. So I started researching 2022 every possible way to better my financial path, that met my goals and risk tolerance. Again, I love the cash flowing assets. So I was in this mastermind options group, which monthly premiums. So someone mentioned infinite banking. Hey, got to check out this concept. It's really interesting. So I did a deep dive. And first thing I thought I was actually mad when I heard about this concept. No one told me about this. I had great CPAs, financial advisors. No one said a word. I would have done this 30 years ago, although I was probably too young and stupid to take action back then. But you can't rewind the clock or put the toothpaste back in the tube. You can only improve your situation today and in the future. So I had a strategy call with Brent Kessler, May 12th, 2022, changed my financial life forever. So I redirected all that money that I was putting into my 401k, plus other money I was saving, into my first policy. Oh, and I wasn't even insurable at this time, but there was nothing was going to stop me from practicing infinite banking. So my first 3 policies I own are on my wife's body, so she has so much death benefit, she sleeps with one eye open. So about 2 months after my first policy, I sold a property, had all this money for a dump in, did a very, very large dump in. 22 days later, took a policy loan, put it into a private lending deal, which I still have today. And that's when it became real. When I actually got that money, they moved from the insurance company to my checking account. And I'm like, this was really, really easy. And this is very true. So I'm like, I got get another policy. So I got the third one on my wife within 2 months. So she was maxed out. Insurance companies aren't going to let you overinsure a human being the same way they're not going to let you overinsure a car. So basically maxed out her body at that point. And then shortly thereafter, I fired my financial advisor who was managing my solo 401k, rolled that money over to a self-directed IRA, which gives me control of those assets and a lot more options to invest in it other than stocks and bonds. But all the money outside of my IRA goes into a policy first. You heard Carson say it. Brent Kessler says it all the time. Chris Naugle says it all the time. Just changing one step in our life where our money goes first. And that's it. Money goes there. I take a policy loan. I put it into either private lending, mineral rights, oil drilling, income producing ETFs, closed-end funds, anything to generate that monthly cash flow. So cash is king, but cash flow is emperor. So my money's always going in this circle. And once that money coming back every month is greater than the amount of money I spend, it's job optional at that point in time. Now, again, I can do whatever I want with that money. I could spend it. I could go have a party with it, or I can put it back into a policy, put it back into the investment. So right now I'm putting it right back into the policy, letting it build up again. And another deal, another private lending deal or mineral rights project. So the money's always moving in a big circle.
A couple questions I got for you. So you've been investing for quite some time. So before infinite banking, you essentially had your money in the investment bucket mainly, correct? All your portfolio was just in the at-risk bucket.
Oh yeah, it was hardly at risk. The majority of it was in the stock market. Yeah, absolutely.
Did you at that point in time have any sort of fixed income strategies in place, either deferred
I did. Yeah, because I always liked that, the stuff I was managing, and I had a financial advisor handling my retirement accounts, but the stuff I was managing, because I love that monthly cash flow, get that dopamine hit of getting that check, or that deposit every single month. So that's really what I enjoyed, and it's real. It's not dashboard money. The stock market goes up. It's not really yours unless you sell it. And I never knew when to sell the stock. So I always wrote it up, wrote it back down. So I'm back to even again. But when you get that monthly dividend, distribution, royalty, it is yours to do with it what you want. So I didn't have a large percentage of my portfolio in that fixed income bucket. I had the majority of it, in the hope and pray bucket in the stock market, out of my control.
Yeah. Because as you alluded to, you can move the monies around from bucket to bucket as you go through life. In the earlier years, you might not have the 30-30-40 split. You might have a 50-50 on something. You might have 90-10, something like that, and 90% in the markets, 10% in other things. But the white paper that Carson shared was more referring to when you're at retirement age. That's kind of the ratio that they recommend, or they found was the most efficient. So that makes sense?
Yeah.
Yeah.
So now I'm at the point. Now I'm at the point where money's working for me, so I don't have to work for it. Now I don't think I'm ever going to retire, like Nelson Nash says in his book. It's to put out a service, and I see how my father has declined since he retired. So I will always do something, but it is a nice option to have, to say I'm done. I don't need this. It's a very peaceful, stress-free place to be in life. Yeah. And now I'm up to 11 policies, and that really helped accelerate getting to this point in my life. So I give my dollar two jobs. I make money in the policy and in my investment. Also, I have the death benefit that I'll have to protect my family. I am finally insurable now, by the way. And so all the money in the policy is protected against liens, lawsuits, and judgments. And now I have
Florida.
Go ahead, Brian.
Because you're in Florida, yeah, because that is one of the states where it is protected.
Yep. And a year ago, I got a long-term care policy on my wife and I. So I'm protecting all that money I've created through my banking system, because long-term care could be the greatest expense we face in our later years. Not let care for me or my wife wipe out what I've worked so hard to achieve. Yeah. So, we're living longer and longer, and the length of care is increasing. So it's not unreasonable to spend $2 to $4 million for care, which, some of these events could take 20 years, Alzheimer's, dementia, Parkinson's. Yep. So I'm not going to be paying for it. I transfer that risk to an insurance company. One America is the company.
Yep. And by the way, so we do long-term care. So if you guys are interested in something about that, just reach out to us. We can help you with that as well. So Mike, another question I have for you is, you said you have 11 policies. So how many people is that?
I have 8 different bodies insured. Now I have 4 on my wife, and then my 3 stepsons. I finally got my policy on myself a year ago, January. So they're charging me an extra fee due to cancer history. So I'm paying an extra $12 per thousand of coverage for 5 years, which comes to $15,800.04 a year. I'm just throwing away, but I don't really care. This is such a valuable asset to me. It's worth that extra $16,000. So Chris always says cost is only an issue in the absence of value, and these things are chock full of value.
Yep. I have a client
I'm still searching for bodies. As soon as I get my first grandchild and they get a social security number, I'll be getting a policy on them. So
that 3 weeks usually, right? Something like that.
Yeah. So and all that money, is in the policies, not subject to any kind of political influence. Don't care who's in the White House, not subject to stock market gains or losses. Every dime of it's guaranteed to be worth more in the future, and not a penny of it's going to show up in a federal or state tax return. So to me, this is an IRS cheat code, legal cheat code. I thought this was too good to be true 4 years ago. Blew my mind, and it still does to this day, even after having 11 policies. And now some of my older policies are at the efficiency point, and these things just keep getting better and better every day. So anyone can get there by first taking action and just have a little bit of discipline, consistency, and patience.
Every single day, your money is losing ground. Inflation is eating your savings. Debt is draining your income. And the financial system, it was never designed to work for you. But there is a way out, and the wealthy have known about it for decades. I'm hosting a free live training where I'll show you exactly how to eliminate debt like the wealthy do, how to preserve and protect your capital from the forces working against it, and how to build a clear step-by-step path toward true financial freedom. No gimmicks, no fluff, just a proven system that puts you back in control of your financial future. Seating is limited and it is completely free, but you need to act now. Click the link below or scan the QR code to reserve your spot today. The wealthy don't wait, neither should you. Now let's get back into the video.
So on this website, you come down here and it'll show you all the states. I'm going to blow it up a bit bigger. And so Mike's in Florida as an example. So down here, you'll see it says at the very top of that right there, it says exemption amount of the cash value, specifically the cash value, because that's the liquid part of the policy, unlimited. So that's awesome. So that's why a lot of people will put a lot of their liquidity through life insurance, because it protects it and it privatizes your money. Two very big things. I'm in Idaho, unlimited right there. I used to be from Washington State. Washington State is probably one of the worst ones. It is not provided, no exemption, no protection under Washington State law. California, where Carson's at, they only exempt a certain amount. So 15,000 and change if you're single, double that if you're married. New Jersey. I knew Dottie had to ask the one state that is unclear. So New Jersey, this website says that the statutes are unclear as to how it is protected in that state. Pennsylvania, unlimited, so that's a good state to be in. Arizona, I believe, is a good one as well, unlimited there. I know Alaska is one of the is like a weird one, has 500,000. The Dakotas, I'm sorry if you guys live in the Dakotas, they are limited as well, but there you go. So Colorado, 250,000. So every state's slightly different. Most of them are unlimited protection. So there you go. Kind of cool site though. Now, question I have a few, Mike, before I dive into my stuff. How do you plan on using your policies for retirement? Do you plan on using them for income in retirement?
I'll probably build up the cash value a little bit more for safe money, because anything, zero risk in the policy itself. Any risk is you take that money out and you put it in cryptocurrency or whatever, but you can mitigate that risk by investing in what you know, like, and understand. So I am assuming some risk. Probably my lowest yielding investment right now is about 10%. So yeah, I'll probably just keep a little bit more in cash value in the policy, or definitely going to talk to you, Brian, about annuities. I was always like, when you hear, oh, fees are too high, I don't want this horrible rate of return, but I'm warming up to them and I love the guarantees. As you know, I've had a few investments that have gone the wrong way, and that cannot happen obviously with annuity or any investment now at age 60. It would be too hard to recover. So I think I am going to pull a chunk from my IRA and put it into an annuity to get that guaranteed lifetime income stream.
Awesome. And then one last quick question here. Someone says, can you explain the cheat code again? And I think they're referring to the taxes.
Yeah, but so loans aren't taxable. So your policy could grow and grow and grow over the years. What you put in, you got the dividends, you got the interest, and you could take out rough rule 90% of your cash value, no tax involved. You can do whatever you want with that money. So people do that in retirement, take that policy loan. You could withdraw money, don't recommend that, because then you're taking money out of your bank. So I would never, ever withdraw from my policy. We'll always take policy loans. So you could take $1 million out via policy loan and not pay a dime of income tax on it. So that is what I'm referring to as a legal cheat code.
Okay, there you go. Dex, you're asking a question, says, so if you're in California when you get your policy and then you move to Arizona, my research, once again, I'm not an attorney, not legal advice here, financial advice. My research says that it's wherever you reside is the laws that will apply to that policy. So if you move from California to Arizona, then Arizona laws would apply to the protection of the policy, because that's where you reside. That's my understanding of when I've done my research online. I have not talked to an attorney about that before, by the way. So, but that's my research. All right. So I'm going to dive into my section here. So what I'm going to be sharing with you here real quick is just some retirement knowledge. And then I'm going to go into a different product that we're using now to really help people do some very unique things in retirement and actually have a really good strategy in place. So retirement income. So your parents versus you, or Mike Samet versus me. No, just joking. So in the past, more retirement was structured this way, where you had a small nest egg. The Social Security was, your kind of your backup. And then a large majority of your cash flow in retirement or income in retirement was going to be through a pension. Now, why pension? Pension is one of the guaranteed incomes. Now, in the past, a pension, though, still could be at risk and it could still be lost. If the company, your employer typically, was managing the pension poorly, they could blow the pension fund up and you could lose all of your retirement because it's happened. You can go look on Google and you can find out companies where they've, blown up, gone bankrupt, and all of the retirees lost their income, lost their pension. But generally speaking, a pension was one of the main ways that you would have income in retirement because it was guaranteed. Unfortunately, because of certain things that have happened, especially in the 80s, that's called the 401k, by the way, the 401k came in and it replaced the pension with the 401k. But what it did is it transferred the risk from the employer to the employee. And so what you see nowadays oftentimes is a nest egg, which can be comprised of qualified retirement accounts like a 401k, like an IRA. Then you have Social Security. And then maybe if you're lucky, you might have a pension. But unfortunately, what's happened is a large majority of people's portfolios are now at risk or in the risk bucket, which is what Carson was referring to in that white paper. And then you don't have as much in the guaranteed bucket. So we're going to talk through this a little bit. So what are your largest assets? For most people, they view their home as their largest asset. We've all heard about that, right? But does your home provide cash flow? No, it does not. So is it truly an asset? Not really, not unless you sell it or you leverage that asset. Then you have your 401k, which a lot of people have those, but very few people, and it's the numbers, like I don't know what it is, Stefan might know it, a very small percentage of people that have a 401k have a large enough 401k to really retire on comfortably. Then you got Social Security and you got pensions, right? So most people's, unfortunately, their largest asset is going to be their home or the 401k, but not Social Security and not pensions. All right. So let's talk through that. So Social Security, is that guaranteed? If as far as we know, it is, but is the government guaranteed? That's the question. Now, I can't really speak to that right now. A lot of people say that we're so upside down on the pool for Social Security that at some point it's going to be in trouble. But if the government just keeps printing money, maybe it'll always be there. I don't know. I'm not really banking on it for myself or my wife. Okay. So what most people are not focusing on, and a lot of financial advisors, I'll be honest, are not probably doing this, is they're not securing more guaranteed lifetime income. Now, why is that? Well, we're going to talk through why the financial advisor might not do that or want to do it. And Stefan's going to talk more about that. So I like this quote here. This is from Time Magazine in 2012. It says, securing at least a base level of lifetime income should be every retiree's priority, at least if they want to live happily ever after. So how do you do that? So sources of guaranteed income during retirement. There's mainly three, by the way. There's mainly three. The first one is going to be, used to be pensions. But once again, those are kind of they're not common now. They're kind of uncommon. Then you've got Social Security, which is backed by the government. And the third one, which you've been alluding to, is annuities. Now, there's different types of annuities I'm going to go through here in a little bit. I'm not going to cover all of them, but just kind of give you guys a little overview of them. And I'm going to show you guys a case study of what we're doing with one of our clients right now. But these are the three sources of guaranteed income. And so you want to be building these things up as much as possible. And unfortunately, once again, most people are not. Now, here's the reason why. So why might you not hear about a pension or annuities from your advisor or your financial planner? Because annuities pay a very small commission one time. Similar to life insurance, by the way, does not pay residual commissions for 5, 10, 20 years down the road. But when a advisor manages your portfolio, including a 401k, an IRA, mutual funds, that kind of stuff, that's called assets under management, and they make fees for as long as you have that portfolio underneath them, which means forever almost until you take it away. And so they're making residual income for themselves off that. So that's why they don't like talking about annuities, in my opinion, or life insurance. So when it comes to retirement, success really happens when you answer these two questions, or it depends on the answer to these two questions. So I ask these questions, by the way, when I'm talking to you, to people, to clients. How much guaranteed income, lifetime income, do you have currently? And then have you taken the key retirement risks off the table? So a lot of people don't know the answer to those questions, or the answer is no and no. You want the answer to be yes and yes, right? That's what you want it to be. So why did you secure secured guaranteed income? So these are all the risks. I'm not going to go through all of these right now, but these are the risks you got to be aware of. Longevity, living too long, deflation, inflation, long-term care, mortality, regulatory risks, taxation, sequence of returns. All of these things are risks that you want to remove off the table. And so like the annuities, the life insurance, they start to remove these risks, right? Whereas the investment portfolio in the markets, you have a lot of these risks, or all of them. Okay. And by the way, living too long is the number one risk, because if you outlive your income, you're in trouble. That's why guaranteed income is what we're talking about. So how do you reduce longevity risk? If that is the riskiest thing, how do you do that? Well, traditional investments, like I've been talking about, stocks, mutual funds, managed money, real estate, CDs, they cannot do that. Now, I'm not telling you not to do those. I'm not your financial advisor. I'm not saying don't go do those, right? I'm just giving you some information. An annuity with a guaranteed lifetime income can do that. And yet most people are not hearing about these things. They're being bashed by other financial planners because they want to do the other things above for ongoing fees. All right. So what is a So what is a guaranteed lifetime income from an annuity? Think of it like a personal pension. You're funding your own personal pension that's going to guarantee lifetime income from a financial institution, a life insurance company. So it's a paycheck guaranteed for life. As Mike was alluding to, that is financial certainty. Certainty today, certainty that income would be there down the road. And by the way, it can be for you and your spouse. So if one person passes away, the income continues. You can do these kind of things. All right. So here's some other people that are saying things about annuities. I want to share these. These are some pretty interesting quotes that I found. So payout annuities provide more in annual income from 1 million than either a 4% withdrawal strategy or a 3.3 withdrawal strategy. So Stefan can probably speak more to the withdrawal strategy, but it says if you have $1 million in a 401k, the amount you should withdraw is 4% per year. That's the maximum you should withdraw, so you don't lose enough of the value of that 401k to not have money down the road. An annuity provides more income than that. All right. This one is kind of interesting. So many guaranteed income products can ensure that the stream of income from a given amount of savings will not run out or be diminished by market returns. So that removes that market risk, the volatility right there. This one says that research shows that people who buy annuities tend to live longer. That's pretty interesting. And not just because they are the kind of people that have the money to buy annuities to start with. It's apparently that little extra incentive of the annuity payout that keeps people living longer. Now, I thought that was very interesting. So there's another one right here. I found another quote on the same thing. It says, in the United States, a 65-year-old male who purchases a life annuity can expect to live about 20% longer than a male who does not purchase one. That stat blew me away because fear around money shortens your lifespan, apparently. This is another one. This is by Ernst & Young, which was the white paper that Carson just was talking about. And it says here, permanent life insurance and deferred income annuities with increasing income potential outperform investment-only approaches in our analysis. And by the way, they're the ones that did the white paper. I don't know what the date was, but it's right there. I mean, they have done the research. And so I just want to share some of these quotes here because they just blew me away.
Yeah,
Now,
Brian, I like the lifespan thing. I think it's probably because there's no stress in their life. They're living longer.
yeah, it's pretty interesting. Now, I have some case studies on the annuities I'm going to share with you here in just a moment, but a little bit about myself. So, I got my first policy about 14 years ago when my daughter was born, and it was a cash value policy sold to me by my financial advisor. It was not infinite banking structured focused. It was death benefit focused, but I didn't know that back then. And I still have the policy. I'm gonna get rid of it here soon, but it was a VUL, variable universal life policy, and that financial advisor was managing my whole portfolio as well, 401k, investments, other things. Ended up losing me $500,000. Lost my entire portfolio. I went less than zero. I went negative in my net worth because of that advisor. And he can't practice anymore, by the way. So he got his license pulled for other various reasons. But when that happened, that kicked me off on this whole journey to understand infinite banking. And that was about 10, 11 years ago. And I realized that people are just not talking about this or annuities or these kind of things. So that's really how I got my start. Have multiple policies now in my family and stuff. And my strategy with my policies for retirement is more about acquiring assets while I'm building up the cash value and having that cash value from the assets. And then my overall strategy over the next 10 to 15 years is taking those assets and the cash flow and funding more policies on myself, my family, and keep that circle going so that I'm gonna be using the investment bucket to fill up the guaranteed bucket, if that makes sense. So there's lots of ways to do this, by the way. Now, what I want to do right now, I want to share with you this case study. This is a client of mine right now. And to give you an idea of what they got going on, so this individual has some guaranteed income already, and it's about, I want to say it's 90,000 per year. They have that, and it's guaranteed income. And then there's some Social Security built into that, but it's not enough right now. The wife still works. The husband doesn't work anymore because of disability. And he said, hey, I've got $300,000. So they just sold a property, they got $300,000, and they're saying, okay, what can we do with this 300,000 to create more guaranteed income, to have more certainty around their future? Okay, so there's a couple different things that we can do with this situation. So let me go ahead and share my screen. Now these are actual annuity quotes. These are about a month old, so keep that in mind. Annuity rates change, so don't quote me on these being the rates today. Let me go and share this with you real quick. So this is some of the different types of annuities, by the way. So this is an instant income annuity. What that means is that as soon as you put in the funding of the annuity, it provides income immediately for the rest of your life. So on this one, you can see right here, $300,000 is the amount that's going into that annuity right there. You're going to see two people. You're going to see a male and a female right here. What that is alluding to is that this is what's called a joint policy or joint annuity. So let's say if the husband passes away in 2 years down the road, the annuity will continue for the life of the spouse, the wife. And vice versa. If the wife passes away, then the annuity continues for the life of the husband. So it's called joint. You can do single life or joint life. In this case, they want it to be for both of them. So if I come down here, there's also something called a certain period. You'll see it right here. It says 10-year certain period. What that means is that if, let's just say that the husband and wife get in a car accident and they both pass away, the income will continue for their dependents, or sorry, their beneficiaries for 10 years. So let's say they die in the year 4 and their son is the beneficiary of the annuity. He's going to get income for another 6 years. So that's how that can work right there. Yeah, Adam's saying that Social Security 2032 depleted is what they're guessing. I've heard that before too. So let's go look at this. So come down here. You're going to see a bunch of quotes from a bunch of different life insurance companies that we can work with. So this one is going to provide a $1,647 guaranteed income for the life of this couple. Guaranteed. And there can also be what's called inflation protection, where this can go up 1, 2, 3% every year, or every 3 years, it'll go up by a certain percentage. So it protects against rising costs, rising inflation. Okay, so that's that one right there. The next one is what's called a 5-year period certain. So this one will provide guaranteed income for 5 years if the spouse, or I'm sorry, both of the couple passes away within 5 years. It'll provide a 5-year income for at least their beneficiary. So the reason why we want to show them these different options is because the income will be different. So with 10 years guaranteed, it's 1,647. With 5 years, it is 1,647. It's the same, by the way. So that's pretty interesting. So it's the same. It's kind of weird highlight right there. Then we did a life only, or sorry, no period certain. So this is a joint life policy, but no guaranteed income for like the beneficiaries. So if you look at this one, the income is 1,664. So when I was talking with this client, I was like, hey, the difference between the options here with 10 years versus no guaranteed period is 1,664 right there versus 1,647. The difference was like $20 a month of income. So they're saying, okay, well, we like the one that's 10 years in case something does happen to us. At least our beneficiaries, our family can get that income for their life. Now, by the way, you can do that for 10 years. You can do it for 20 years. There's lots of different options. So this is what's called a SPIA, a single premium income annuity, provides income right away. The next kind of annuity I want to share with you here real quick is what is called a deferred annuity. A deferred annuity is an annuity that you say, hey, I don't need income today, but I want the income to start 5 years down the road, 3 years down the road, 7 years down the road, 10 years down the road. So you're going to defer the income. So they put their funds into the annuity. It provides guaranteed growth. Now, this is the amazing part about this. It's amazing. Guaranteed growth for that 7 years, 5 years, 10 years. And then after that, it converts to income that is guaranteed as well. So you're guaranteeing everything when you set these things up. And that is amazing. So let's go ahead and look at this. So this is the same kind of a thing, but this one is a 3-year deferred. So income will not start until 3 years down the road. You can see that right here. 3-year deferred. $100,000. And look at the difference right there. $3,632 of income guaranteed for the life for this couple, the married couple. They have to wait 3 years though to get it. Okay. Now we're going to look at 5 years. So in 5 years, if they wait 5 years to get income from this thing, look at the income. It's $4,116 if they do it for 5 years. 5 years. And by the way, that's a 10-year certain period, which means when income starts, then if something happens with the couple in like the first 3 years, the income will still continue for their beneficiary. So once again, by deferring this for just 5 years, by the way, it went from $1,600 a month of guaranteed income to over $4,000. Now, what other type of guaranteed income has the same kind of structure? Social Security, by the way. On Social Security, if you delay, like you can get it at what, 62 and a half or whatever the age is. If you wait 5 years or 3 years or 7 years, the amount you get from Social Security goes up. Same thing with annuity. You can defer it and get more income, guaranteed, by the way, down the road. Now, the last one I'm going to go here and look at is a 20-year period certain, which means that if something happens to them in like year 5, because this has a 20-year certain period, it'll continue for another 15 years of income. But what you'll notice is the monthly income went from $4,100 down to $2,016. So there's different options that you can look at when it comes to annuities, because they do have a lot of flexibility and options to suit your needs. So in this case, they're saying, hey, we don't really need to get income for our son or our daughter. They don't need this. So then we're not going to do this one right here, but I wanted to show them the options. Okay. All right. Now, that all being said, this was a couple, I believe, I think he is in his early 61 and she's in her late 50s. If they were in their mid to late 60s or even 70s, the amount of income goes up drastically. So once again, I want to make sure I'm clear on this. With annuities, the older you are, the amount of guarantee goes up. The percentages you get that are guaranteed to go up. That's called lifespan, by the way. Now, the last one I want to share with you is someone who's in their 20s. Because a lot of people are thinking about this kind of stuff, saying, well, Brian, since do I really want to do an annuity right now when I'm young, because it's more about income right away? The answer is it depends. But oftentimes, yes, it can make a lot of sense. So let me go ahead and show you this. I think he's in his 20s. And he is receiving a Roth IRA. No, it's Roth or doesn't really matter. I think it's a self-directed IRA. His father passed away, unfortunately, and he's inheriting an IRA. Now, inherited IRAs, they cannot stay in that IRA indefinitely. They have to come out typically after 10 years, they got to transfer to something else. So he's saying, I don't need income from this Roth. What do I do with it? I don't want it in the markets either, because I don't trust the markets right now. So what we're going to do is we're going to roll it over. So I want to make sure that you guys understand what I just said. And an annuity is considered a qualified plan, which means you can move qualified money from a 401k, an IRA, 403bs, things like that. You can roll them if they're convertible at that point in time, or you can roll it over into an annuity without any tax consequences. So a lot of times people are asking us, hey, Brian, I have a 401k. Can I move my 401k money into life insurance, a whole life policy for infinite banking? The answer is not directly, okay? Because one is qualified money, life insurance is not qualified. So you've got to make sure that you're dealing with the tax consequences of those funds first, and then it can go into life insurance, but you can roll it over. So in this case, this client who is 25 years old doesn't need this IRA for income. It's not a huge amount of money. We're going to roll it over to a 7-year guaranteed annuity. That's called a MYGA, multi-year guaranteed annuity. He's going to get guaranteed 6.5% for those 7 years. Well, guess what? If the markets go down, which, I mean, look at where we're at right now, everybody. He's not going to worry about market volatility. He's going to get 6.5%. At the end of the 7 years, what's he going to do? Well, he's going to look at options. He can roll it over into another multi-year guaranteed annuity at whatever rate it is. He can put it into a deferred income annuity. He can create income immediately if he wants to. Yeah, 1035. Yeah. Yeah. So he has options. He has options in that situation right there. But what the whole purpose of what he's doing, though, is he's got other funds. He's funding, investments, 401k, that kind of stuff. So he wants to get some money off the table and put it into guaranteed income. And that's exactly what he's doing at age 25. But he probably will not take income from this thing until he's, 55. But by then, if we do the math on it, this small little annuity has gotten extremely large, very, very large, and is guaranteed the entire time. So once again, everybody, that's just kind of a quick take on some annuity case studies we've done here and how we've helped some clients with this. There's a lot of different options when it comes to annuities, when it comes to your overall strategy. I'm also going to put a link in here to schedule a call with one of our mentors. So if you want to talk about infinite banking, go ahead and grab that link, schedule a call, that kind of stuff. But so Andres is asking, I get monthly payments for the next 10 years from a real estate property I sold. How do I avoid probate and pass that stream to my wife? And any solutions for investing monthly payments? So I can't give financial advice. I'll let Stefan maybe answer the one about investing. But invest in what you know, what you like, and what you understand right there. And depends on your risk levels too. To avoid probate, so you have a contract, you have a note contract, most likely. You just want to make sure that that thing is transferable through your estate or through a trust. I would recommend, and once again, talk to an attorney about this. If you want to avoid probate, a trust is exactly what that does. You could put that note in the trust so that when you pass on, it then passes over to your wife. There you go. And then Cat Wall is saying, what's the longest deferred annuity option? Are there like 15 and 20 years? Yes, there are actually, but the return goes down on those. The longer you have the guaranteed for, the shorter or the less the return's going to be. So oftentimes a lot of people will do like 5 or 7 years. It's a higher guaranteed, and then you can just keep it rolling over to a new one every 5 to 7 years. But once again, you just have to get quotes on that. And then Andres asking, any annuity that also includes a life or long-term disability policy. Life insurance policies can include a long-term care policy inside of it, but oftentimes we just get a separate quote.
Yeah,
Yeah,
they come with a chronic illness rider, so you can tap into your death benefit while you're living to pay for care if you can't meet 2 of the 6 activities of daily living. But that's
yeah.
going to be maxed out and once your death benefit's drained. So personally, I have a separate policy because all my death benefits earmarked for my kids and grandkids.
Yep. So guys, go ahead and keep in the comments in there. I'm going to go and start putting some links in here, you guys, so you can reach out to our team, reach out to me or Tess for annuities. If you want to reach out to Mike for long-term care, just send me an email and I'll connect you with Mike. But I want to bring on Stefan. So Stefan is part of our Private Money Club Wealth Advisor team, and they are financial advisors. But as we like to say, they are not your traditional financial advisors. You're not going to get that traditional financial advice. You're going to get, I'm going to say, more straight advice about alternative concepts and strategies. There's Mike's email, by the way, in there. So, and then also the model that we have with Private Money Club Wealth Advisors is very different. It's not assets under management because that's what most financial advisors want. So we have a very different structure, which he can get into. But Stefan, I'll let you take it away.
Yeah, thank you for a great conversation, great topics all around, and it's been a lot of fun listening to you. I want to kind of start with a question you just answered because I really liked that answer. Maureen asked about whether it's better to do a traditional IRA into an annuity or a Roth conversion. And I loved your answer about how it really depends on what you want to accomplish. And I think that talks about wealth, that talks about what you're doing, how we all work together, and what's so special about what we're doing. Ultimately, it comes down to what you want to do with your own personal finances, whatever you do being right for you. There are so many tools out there: annuities, whole life, investments, traditional IRA, Roth IRA, defined benefit plans, trusts, guaranteed income contracts. There are a million different tools out there, and each tool can be powerful or not powerful in a different context. So really, any conversation is going to start with really understanding you and what it is you're trying to do. The annuities Brian was just talking about are incredibly powerful for protecting yourself against outliving your income. That's the main, and Brian even said it himself, that's the main reason you buy an annuity is to protect yourself from longevity risk and outliving your income, right? And then at the same time, Mike just talked about how, yes, annuities can have, and not annuities, different insurance policies can have long-term care riders. but in a lot of cases, it makes sense to get a separate long-term care policy, right? And so there are all these different tools, and it's important to pick the right tool for the right problem. And that starts with identifying what your goals are and how you're going to solve them. And that's how you make your tool or you make your decisions.
Like that.
Retiring is stepping away from your income source. Brian, you mentioned you've had to start over, and I think a lot of people have to start over once or twice or five times during their life. But once you get to be 70 or 80 years old, you don't want to be starting over again. So when it comes to retirement planning, it's extremely important to be prepared and do it right the first time so you don't have to go back and do it again. Once the money stops from your W-2 income or Mike was talking about how real estate is not really as passive as people think it is with the three T's. It's not easy to turn that spigot back on.
No.
There are a lot of different issues with retirement for a lot of different people. There's Social Security, which we talked about. There's Medicare planning and making sure that you don't run into problems with IRMA and having to pay tax or additional Medicare premiums because your income is too high. There's long-term care planning, which is a huge factor for a lot of people. I think the average retiree now can expect to spend, what is it, $280,000, maybe more, on healthcare over the course of their retirement. And that's excluding the chronic long-term cases. There's longevity planning. More and more people are living to be 95 and 100. I heard Steve Nagy the other day mention that as advisors, we used to plan for people to live to be 85 to 90, and now we have to plan for 100, 105 to be safe. And there's the impact of inflation over time. So there are a lot of different factors to consider when you're looking at retiring. And one of the things I really like about the approaches that I've heard on the call from you, Brian, from you, Mike, is that you're very focused on using annuities to solve a specific problem. You're very focused on using long-term care to solve a specific problem. So for instance, annuities, make sure you don't outlive your income. Long-term care, make sure that you don't wind up having to pay millions and millions of dollars for chronic health care. But not all annuities are the same. There are a lot of different, more complex annuities out there that try to blend multiple things into one. In your examples, you talk about SPIAs and deferred annuities, but there are also these things called variable annuities and fixed index annuities, which can sound really, really sharp, but they can be incredibly complicated, and it's very easy for someone who's buying them to get stuck in something that's not appropriate for them. So annuities can be very complicated, and before you buy an annuity, it's incredibly important to talk to someone who you trust and who you can trust to put you into the right annuity. The same way, if you're looking at retirement planning, it's important to work with someone who you trust and not someone who's going to sell you the thing with the highest commission for them. So I would encourage you to talk to the advisors or to the money mentors if somebody else is showing you an annuity. There are these variable and index annuities, and why do people put their clients in them? Because these variable and index annuities can have incredibly high commissions because they're complicated. I worked at another firm where a person was getting $100,000 commissions for variable and index annuities. It's crazy. And so I would encourage you, if you're talking to someone who's trying to give you an annuity, to talk to Brian, to talk to Tess, to talk to your mentor, and make sure that you get their take on it too. Make sure you get someone who's going to put you in a good annuity for you, the right one, not the one that's going to pay them the highest commission. And if you have questions about a retirement plan, like Brian mentioned, we are a little bit different from other advisors. We get paid a monthly subscription to give advice. And that allows us to sort of clear our minds and clear our incentives from compensation for any one tool. we don't have any incentive to put you in one type of investment versus another. We believe that approach of paying for advice allows us to help you find the tools that are right for you. And for a lot of people, annuities can be a powerful tool. So again, I encourage you to talk to talk to the mentors, talk to Brian, talk to Tess, talk to Mike, talk to Carson. If you're thinking about an annuity, or if somebody else is showing you an annuity.
Yep, and yeah, the index stuff we tended to stay away from it because unfortunately, a lot of people have short memories, as I would always say. And right now, we're in the longest bull run in history. And so a lot of people have not seen the results of a downturn in a long time, and they forget what it looks like. And a lot of advisors, I believe financial professionals, are taking advantage of this bull run and showing, look at the last 10 years, look at the last 15 years. It's amazing. Okay. But in history, that has never continued for longer than we've done it today. 15 years. It's usually 8 to 12 years, I believe, is the normal time frame. We're
Yeah.
15 years in on this thing, and that is actually really scary.
Yeah.
Really scary.
Yeah.
Because the longer it goes up, the harder it falls historically.
Mhm.
And the market goes up, it goes up like 5 times or 10 times slower than it drops. So that's why you always see this going up, going up, going up, bam, and it slams down, and then it recovers slowly, then it goes down. And that downturn, we believe, is going to have a drastic impact on indexed products.
Mhm.
But once again, there's a lot of advisors, by the way, financial professionals that have not gone through a downturn either. And so they're just looking at the best growth possible. That's what's going to happen. That's where it's going to be 15 years down the road, 20 years down the road. Yeah, be very careful of that. Be
Yeah.
very careful of that.
Yeah.
Uh,
And, make sure you talk to someone if you are thinking about that. Just get that extra perspective. Talk to Brian, talk to Tess, talk to Mike, talk to Carson. Get that additional perspective on it
yeah.
before you do something. Because again, retirement is something you only want to do once. So if somebody else is showing you something, have that extra conversation that'll give you extra confidence.
And I would say this, you don't want to come out of retirement.
No.
Now, if you're a musician or something like that, that's different. They always do that. But yeah, you don't want to come out of retirement and have to, and I'll just be honest, have to be a greeter at Walmart or something like that because you need that income because you're well, too scared of the markets, too fearful of outliving your money, and there's a whole list of other things. But that is one of the biggest fears in retirement is running out of money. It's not long-term care because most people don't think about long-term care because they haven't experienced it before. But the two things, long-term care and running out of money, one of the two things that a lot of people are starting to realize, uh-oh, I got to make sure I take care of this. And so we want to make sure we shared with you guys some topics here because we always talk infinite banking. That's the main thing we talk about a lot because it's an amazing process and concept, that kind of stuff. But there are other things that can complement or add on to infinite banking as part of your overall strategy and plan that can benefit you. Ms. Sherry, if you're referring to like annuities or infinite banking, just let us know because not all of us do. Like Mike does long-term care, I don't. I do annuities, he doesn't. So just kind of keep that in mind. But if you get on a call with someone that doesn't do that, we'll get you with someone who can do it. All right. I think that's all the questions right there. So I appreciate everybody being on and appreciate you guys answering, getting all these questions in there. J.R. Wilson says, I am disabled as well from a TBI. Okay, gotcha. And Stefan, you answered Maureen's question about the traditional versus Roth, all that kind of stuff, correct?
Kind of same thing as your answer in a lot of ways is it really depends on what you're trying to accomplish. And
Okay.
starting with that,
Yeah.
I also can't give personalized advice, but in general, it always starts with what are you trying to accomplish? And then from there, you build what is the right tool, what is the right approach for you.
No. And then the one question came in here from Barb. It says, can you roll over a pension? And then she's referring to an annuity. Can you roll a pension into an annuity versus a 401k into an annuity? My response on that one, it was this, and I want to make sure that I'm stating this correctly. So possibly. It depends on the structure of the pension. Because pensions have so many different structures and rules and regulations around them. What you'd want to do is call up the custodian of the pension, so who manages it, and just ask them, can it be rolled over to another qualified account? Is that correct, Stefan?
Yeah, exactly spot on. It's going to depend on the rules of the pension. A lot of them you'll get an opportunity from time to time to take a lump sum distribution, which you could then roll into an annuity
Okay, so yeah, because I
or
wasn't
an
sure.
investment account. Yeah, whatever is right for you. A lot of them will give you that lump sum opportunity from time to time.
And then are there pensions that don't allow you to do that? You can't touch the funds, you can't move it. All you can do is get income.
I would assume so, but I don't know off the top of my head. I would assume that there are unless they give you the opportunity to. But most of them, most of the time, the pensions would like you to take a lump sum. So
Right. I've
yeah.
heard that where they're out. This is a good kind of a case study. A client, and I want to go back to this client now because I wasn't talking about annuities back with them at this point in time. They have a pension, but the business is being bought. And so all the employees are getting a lump sum from the pension, and they're basically not, they're getting fired. That's kind of what is happening. But the new owner of the company is not going to continue the pension. They're going to do 401k or something. So they're liquidating the pension plan. And so all these clients or all these pension um, participants are going to get this lump sum. And they're like, oh crap, what do I do with this? Because it's coming
Hmm.
to you, you have options. You have a certain period of time to do something with it, or they're going to give it to you in cash, which then you got to pay penalties and taxes, depending on how it's structured. So in that scenario, yes, roll over to an annuity is an option and it avoids the taxes and all that kind of stuff. So
Hmm.
yeah, that is a conversation I remember had. That was about a year ago. And then Kathleen's asking here, can you take the money out of the deferred annuity if needed? What are the fees and taxes? That's a great question. So the answer is potentially yes. So one, you can cancel the annuity and get the money out of it usually, but there's going to be growth, taxes, all that kind of stuff. But you can build them a deferred annuity where you have the option to take 10% out per year. Like there's like 5%, 10% typically are the numbers. So if you have a $100,000 annuity deferred like 10 years, but you have that provision built in, you can take like $10,000 out of the annuity. Okay. Now, there might be taxable events when that happens, or there can also be a 10% penalty for early withdrawal, depending on how the annuity was funded. So annuities, when you receive income from them or you take a withdrawal, a permanent withdrawal, the tax consequences and fees are based upon how the annuity was funded. So, and yeah, there's also called MVAs, which is market variable adjustments, which means that when you take money out of an annuity before you're scheduled to do so, they may adjust the return of that portion based upon the current market value and what it's done. But that's typically has to do with also index products sometimes, but it can be a part of any annuity. But that's just part of understanding these kinds of things when they're set up and having like Stefan mentioned, talking to the right person, having them walk you through the ins and outs of the annuities, the pitfalls, the options, all that kind of stuff. Because I'll be honest, I've talked to a lot of people where unfortunately the advisor did not share with them all of the pitfalls of the product, and they come to like me or our team and they find out, wait, they did what? If I do this, I get penalized. Yeah. And they are very upset because once again, that person did not explain to them all of the features of that product. All right. Well, everybody, unless you guys have any other questions, I'll let you all go. Rodell, I'll try to reach out to you as well and then give you a phone call or an email. But appreciate everybody. If you need anything, let us know. Reach out to us. We're here to help, and we will see you in the next webinar.